All right, so Steve writes in, he says, should I max out my 457? And a lot of us don't have access to a 457. So just the same would be a 403B, a TSP, or obviously a 401k. So max out your retirement plan versus opening a taxable account. He's currently maxing out his 457 at 26K a year. He could reduce it to 70,7500 a year to get the match and then put the remaining 18.5%, 18.5K into a taxable account. He would still be in the 12% tax bracket, and because he could get a better, lower expense fund, the expense rate should be reduced from 0.55 to 0.06. Unsure if capital gains tax later would not make it worth it. What should we say? Okay, so I'm telling you, man, stop maxing out your 401ks. I cannot stress this enough. Just got off the horn today with some folks. Everything they've got is in 401ks / IRAs. Everything. They're going to retire before they're 65. Oh man, thankfully this guy is 61, so he has access to his money without a 10% penalty. Talked with a law enforcement officer, federal, earlier today too, and he is 51. So thankfully, because of Donald Trump, the 72T rules of access to your retirement plan money is applicable to him because he's a Leo, for a first responder essentially. So that's a big deal. But for a lot of us, it's not, man. For a lot of us, we don't have access to our 401k money until we're 59 and a half without having to pay a 10% penalty. I'm telling you, and it just sucks. And then in this case, these guys are 61, and all the money they want to do all kinds of fun, party like it's 1999. Everything they're going to pull out from their money will be taxable as ordinary income. Everything. Now they're not going to get killed tax wise, but I mean it does put a damper on some of the point. They want to buy a boat, for instance. I showed them how much it's going to cost. They buy a boat, how much the tax is going to be. It's going to be nuts. They can't do that, so they have to take a mortgage, take a mortgage on the boat, take a loan. Now, it's actually in this case it makes sense to do that anyway. But what I'm saying is, when everything is in retirement accounts, it limits your ability to do other things. I'm telling you right now. I'm just telling you. Don't put everything in retirement accounts. Stop maximizing it. Now, this dude's only in the 12% tax bracket anyway, so he's not getting much of a benefit anyhow. If you're only in a 12% tax bracket, man, you're not getting a huge benefit anyway. You're going to save, 12% on $100,000. I mean, well, not 100,000, 26,000 bucks. You're going to save 12%. So today, how much is that? Well, 26,000 bucks minus 12%. You're going to save all of $26,000. You're going to save all of 3,000 bucks in taxes today. You're going to pay that 3,000 bucks hand over fist in the future when you no longer have an income stream. On top of that, if you do an ETF like a Vanguard VTI, there is no capital gains. The dividends are minimal, so basically, if you're still in a 12% tax bracket, any capital gains there won't be, but any capital gains that you receive will be tax-free, and the qualified dividends will be tax-free as well. Stop maxing out your 401ks, please. For the love of the good Lord, don't do it. Now, if you're in a 35% tax bracket, it's different, man. I mean, every situation is different. If you're in a 35% tax bracket today and you live in New York State or California, yeah, I mean, my goodness, max out your 401ks 100%. But if you're like this guy, 12%, if you're living in a tax-free state, or if you're living in a tax-friendly state, oh man, even though I'm in Georgia, and once I hit 65, there'd be no state income tax for me essentially, because once you're 65 years old, you have $65,000 of tax-free income per person. So between Charlotte and me, it's 130,000 bucks tax-free. I'm just telling you, man, that's not worth it. The savings today isn't worth it for the limits that you have in the future. I'm telling you. All right, love to hear your thoughts. We'll see you.